Hey everybody, this is Justin Bogar with BrightPath Notes again, and we just got done explaining passive loans versus active loans or notes. Okay, so now let's dive into what typically people think of when they want to invest their money in stuff either long term or short term. And so the three categories that I have are the stock market, rentals, and notes or mortgages or loans, however we're describing them today. It's all kind of the same thing. It fits into this category, okay? This is being the bank, this is being the landlord, and this is just traditional investments that we all know about. And so in the stock market, you typically get into a mutual fund or you have a 401k or some sort of retirement, and you have someone that manages your portfolio for you. So you have a portfolio manager, okay? And they will typically go out and find these packaged stock market funds for you, and they take their little percentage and their dividend off of that, and then you are secured by nothing, right? So, for example, if you had all of your money invested in Apple stock, and Apple decided to go under or they dissolve their company, you would get zero. Your stock will be worth nothing, right? You would have all that money invested and then it would become nothing. This is what makes the stock market so volatile. When you see these the clicker board, that's the stock market right there, okay? It's very volatile. There's nothing consistent about it. It generally raises or rises over the course of 20, 30, 40 years in the long run, but it's very modest. It's probably, it's tough to say, maybe 5, 6%, at the most, what it raises. Some years it's 20%, some years it's negative 10%. This is what makes it so volatile. So that's traditionally what the stock market looks like. So people can make a lot of money in the stock market, they know what they're doing, but most of us just give it to a fund manager and let them do the work for us, okay? Now when people get into real estate, they traditionally think, oh, let's be a landlord, let's get some passive income that way. Well, lo and behold, when I got into the rental business, it was a little more active than I thought. Some people have situations to where they have a really good rental and good cash flow, and others have a little bit of problems. So you have tenants, you got toilets, and you got trash. Okay, I call those the 3 T's: tenants, toilets, and trash. Because as a rental, you are what they call the home owner. Okay, you own the home, which could have its pluses, but also has its minuses to it, and we're going to talk about that. Okay, so you own a home. So the home appreciates in value, right, over time. Sometimes it dips, sometimes it rises a lot. So you get appreciation. We'll say APPR, so I don't have to write very much, okay? Okay. You also get to write off on your taxes depreciation, right? So we'll call it DPPR. Okay? And you also have what's called depreciation recapture. So the government says, hey, wait a minute, let's take some of that back, okay? So being the landlord and the homeowner, you have to deal with tenants, toilets, and trash, property management companies. You are the homeowner, so you're liable for everything there. So there's risk there, right? That's your risk. If I could write well, you could read that. That's your risk. I still can't write well. Okay? So we have to have special insurance on there because if somebody trips and falls on your sidewalk and they want to sue you, you're going to be the homeowner. So that's the big risk here with being the rentals. You can have great cash flow, but a lot of the cash flow of the work is done month by month with this tenant that really has not a lot of vested interest in wanting to stay there long term. So you have to go through this process again of vetting the tenant and getting the right person in there and collecting their, not their down payment, but what I'm trying to say, getting their security deposit down and stuff like that. So that's all the things that come with rentals. So there's a lot of work involved with being a rental, so we call this more of an active investment because there's not a lot of rental situations where they become very passive, okay? So there's a lot of money that's being transferred back and forth, and at the end of the day, you end up making not as much money as you thought, because you always have to fix a home, right? A home always needs to have repairs done. It always needs to have a roof replaced. It needs to have a furnace updated. It needs to have drywall repair. It needs to have flooring redone, paint, carpet. All those things are involved because you are the homeowner, okay? Move over to what we're talking about in today's lessons are notes, or we call them mortgages, or we call them loans, okay? This is cash flow. Because month after month, we're talking about performing loans. Month after month, you're receiving cash flow. And the only person involved between you and the borrower is the loan servicer, okay? The loan servicer will collect the payment from the borrower. They will do all the communications with the borrower. And they will push that payment minus their fee, which is pretty modest. It could be anywhere from $20 a month to $40 a month of what they collect on a payment. Sometimes they're flat fees. Sometimes they have other costs associated. But generally, it's a pretty modest fee, pretty small fee to collect your payment, to collect the payment for you, and also push the payment back to you for your cash flow. So what's great about being a note investor is that you don't own the home, okay? You are the bank. Put that up here. Let's make this very obvious. And you just have to think to yourself, does the bank care about your toilets? Does the bank replace your roof for you? Does the bank worry about windows being replaced? No, because the bank doesn't own your home. They are just the debt owner on the home. So this is what we like about the note business as compared to rentals and as compared to the stock market. So you have nothing securing your investment over here. Over here you actually own the home, so you get some positive and some negatives there, but it's a lot more work. And over here you don't really do any work. You're just the bank. It's just a set it and forget it type of mentality, and you are the bank and you're receiving monthly cash flow. So down below is a translation that you've been seeing if English isn't your primary language. And this is what we invest in with BrightPath Notes. And so I'm Justin Bogard, and this is what we do. We buy loans, we sell loans, we help people create loans. And these are the investments that we're talking about today. So we hope you enjoyed this lesson and look forward to following us on social media. We have a Facebook page, which is BrightPath Notes. We have an Instagram account, which is also BrightPath Notes. And we have a Twitter account, which is BrightPath Notes. You can go to our website, which is listed below. It's brightpathnotes.com, and you can see some of the note deals that we have. You can look at more videos and blogs that we've done. We also have a couple of podcast episodes that we've been interviewed on, and we're also starting our own podcast as well to convey more information about the note investing world and why we do it. So I'm Justin Bogard with BrightPath Notes, and don't forget, we've got the deal flow to make your cash flow. Thanks.